Love the energy. Oh my God, that was so good, right? I hope we can keep up with the energy that Jeanette and her team had. I'm really excited to be moderating this panel with awesome people on the stage here. And I'm not going to go in detail about their profile because you can scan that code or you can check out their LinkedIn if you haven't already. Today we're going to focus on money and how that relates to funding your startup, especially in this climate where everything feels like it's going downward. But let's see what the experts have to say. I am going to introduce just slightly. So I'd love to introduce first Rachel, because I've known her the longest. So I've known Rachel for about, I think, 4 years in the startup space, and she's been one of the leaders in impact space and has been an ambassador for impact investment, but also just startup in general and entrepreneurship in general through her role at Giant Leap as well as Startup Week. So really excited to have you here. And then we've got Corinne, who's had many years of deep experience in finance and sustainability and helping founders build financial capability. I think that's the skill that as entrepreneurs, even though you may not like finance and accounting, you will need to like, and you will start liking, hopefully. And then we've got Stephen, who is been a long advocate of youth empowerment for a very long time. And today it'll be great to hear his perspective around entrepreneurship and how he is building the capability of founders. All right, so with that, let's start with introduction. And I am going to throw to you, Steve, because you are right there in the extreme end. If you could just introduce yourself briefly about your organization and why you do what you do, why it matters.
Sure, thank you. Oh, I didn't blast. Last time I held a microphone in my hand at one of these events, I almost shouted into it and everyone went, ooh. So hopefully that's calmer. Hello, everyone. My name's Stephen Torsi. I'm a program manager at the Lord Mayor's Charitable Foundation. So we are the largest and oldest community foundation in Australia. And what a community foundation is it's a fund holder. So we have a corpus of funds that people donate into, and we manage other people's charitable accounts. So we have quite a significant corpus, and of that corpus, the interest made on that corpus annually is donated in grants to organisations. So as I said, we're the largest and oldest community foundation in Australia. And we have a focus on Greater Melbourne. We call ourselves the Community Foundation for Greater Melbourne. So we're place-based. We're 100 years old. And we have three particular impact areas, what we call impact areas. So we are focused on social and environmental outcomes, mainly on issues of the day. And what we see those issues of the day for Melbourne at the moment, it's homelessness and affordable housing, climate resilient communities, and the area that I work in is called the Inclusive and Sustainable Economy and Jobs area. It's quite a bit of a mouthful, and I can explain a bit more about that as we go on. But I think that's probably enough for an introduction. Thanks.
Thank you. Rachel?
Hi, everyone. I'm Rachel Yang. I'm a partner at Giant Leap. So we're Australia's first 100% impact venture capital fund. So what that means is we back mission-driven founders solving the world's most pressing problems. And we do that across 3 themes: health and wellbeing, sustainable living, and empowering people. So we invest for equity, and we've invested in businesses like Hex, being one of our portfolio companies, Who Gives a Crap, who you may have heard of, a sustainable toilet paper brand, business like GoTerra, which is a company that breeds black soldier flies to consume organic waste, so effectively a maggot farm using robotic technology to breed maggots to eat waste so that it doesn't go to landfill. And then we've got health companies like Sear Medical, which is one that's based in Melbourne, which is Australia's largest epilepsy diagnostic service, which allows you to get gold standard epilepsy diagnosis at home. So really, we believe you can't solve the social problems of today without solving the environmental problems, and vice versa, which is why we have those broad impact themes. we have roughly $60 million under management across 2 funds, and soon to be kind of 28, 29 companies. We're working through a few transactions right now to date, so across the 2 funds, so 20 in the first fund and the remaining in the second, and we'll invest in 20 to 25 in our second fund as well. So very actively investing now and really keen to support the founders that are solving these really pressing problems.
Thanks for that. And Corinne?
Hello, good afternoon all. I probably come from a slightly different approach in that I've probably been the person looking for the funding and the entrepreneur. So I work out how I can both hit up Rachel and Stephen. So my background is I've worked with EY and PwC initially as an accountant, but really was interested in how do you solve for social and environmental issues, and how do you build externalities into the market and therefore build businesses that address that. From that, I went to NAB, where I spent a whole lot of time spending shareholder money trying to build businesses like that, and then more recently went off and set up a fintech with the idea of disrupting the payday lending sector. Unfortunately, we got hit by the pandemic truck, so we didn't survive, but I have all the scars and learnings of what it's like to be there at the forefront trying to work out how to pay your wages. I've now gone back to my true passion, which is the environment, and I'm on a steep learning curve at the Trust for Nature to learn about how do we actually build caring for country into financial models.
Thanks for that, and we will definitely touch the question around your learnings from, being a founder and going through the fundraising process. But before we do that, I'd love to hear from Rachel around the funding landscape. So when you're thinking about a startup idea, where do I need to go first, or what does that journey might look like until you see me at your table, assessing the deal? So what would that look like?
So the journey is really different for everyone, and you don't need to take funding necessarily. There are lots of things that you can do beforehand and before taking funding, getting grants or even talking to friends and family and maybe getting a little bit of investment from them to start off with to get yourself off the ground. I would, in the first instance, actually steer away from getting external funding because you do give up part of your business in the very early stages, unless you need that capital in order to create the business itself. It is very varying depending on what your needs are. I think people look at venture capital and look at funding and think that that's success in and of itself, and that raising funds is really the success mark. But actually, if you can avoid it and be in control of your own destiny in the early stages, you're much better off, because then you can just pivot and do what you need to do to actually find the right product market fit. And there are a lot of grants out there, and particularly we're very lucky to be in Victoria, where there's a lot of government support and grants, and even Breakthrough Victoria and others have been created to really support the entrepreneurial ecosystem. And I'm also the chair of Startup Victoria, and so we're a grassroots organisation that helps founders succeed along any part of their journey. So really drawing on all of the many resources that are publicly available and also the communities and networks to help yourself understand what you need, and then looking at funding beyond that. There are some great guides out there, like Cheryl Mack has Max Resources, which goes through a range of different funding sources, even debt funding, all of those different options out there for you. But I would be exploring on what suits you personally and your business needs before just going straight for venture capital or straight into kind of getting yourself into a big amount of debt or anything like that early on.
Yeah, I think just to add on to that, don't get enamored with all of these, I raised $20 million in like 6 months or something like that story. The life is a bit harder, which I'm sure you'll be able to say. I would like to ask you, Corinne, regarding social impact startups. Now, there are startups that really want to solve the problems. Should they be starting as a non-for-profit or a social enterprise or a for-profit? Like, what do you think we should do?
Look, I think it depends on the sector. And in some businesses, it is essential for the credibility to start up a not-for-profit. So when I set up Speckle, which was to tackling, the likes of cash converters, it actually made sense to set it up as a not-for-profit, because we wanted to differentiate by being the essence, not making money and not redistributing it. So that was a design for us. But there are many models where you could actually tie the impact in through whether a social enterprise model or a B Corp, where you can explicitly make it part of your constitution. The differences are, and it is that fundamental how deliberate is my impact as to which choice you go, because your choices then become limited. In a not-for-profit, you cannot have equity. That is fundamental to the structure. So you are only left with debt. And I am yet to find a not-for-profit board that is okay with debt. That is just a very risk-averse kind of crew, so be aware that it becomes hard to then scale. So you're looking at grants. The upside of a not-for-profit is they don't pay tax. So your business case is very, very different when you're not paying tax. When you flip it though, and you go in a for-profit model, that can make sense because you've got equity potentially at the table. But I totally agree with Rachel. Work out what you're solving for before you look for money. I've seen a lot of bank of mum and dad on accounts, and that does work, but that creates a lot of pressure. But I've also seen great business ideas sold off too quickly because they gave away the equity at the early stages. And then they end up earning very small parts of a successful business and not getting the return. So there is some real risks. Think it through. What are you solving for? What's the right structure for you?
Oh, thanks for that. We will be taking questions from the audience shortly as well, so please have your questions ready. I've got one question to Stephen before I go to the audience. Stephen, you've worked with lots of founders. What are some of the mistakes or early mistakes that you see founders make, particularly when it comes to financing? And if you've got any advice on that.
I have worked with a few founders, not lots, particularly social enterprise founders and not-for-profit founders. So just building on what Corinne said there, and it's the people that we support, the organisations and entities we support are usually early stage, or we can support early stage because we're a philanthropic institution. So we are what sometimes is referred to as venture philanthropy. So we can bear risk in our grant making. Our grants are ostensibly donations or gifts. So we're able to bear some of that risk on the early startup journey. Some of the mistakes I think critically that are made early on is when a grant is secured or a portion of funding is secured, is not planning beyond that funding. We see that mistake all the time, particularly when it comes to employing people. At the end of a grant, if you're not planned beyond that grant or that tranche of funding, you could be faced with having to let people go. And we see that a lot in the not-for-profit social enterprise sector because it is quite a lot of the funding is short-term. And that's something that the sector is trying to address at the moment. There's big live conversations about 1 or 2 year funding cycles and how useful they are to early startups. I think they can provide that grounding of funding that you need to experiment and to scope and to do feasibility studies or to do some piloting. But you really need to plan beyond that to avoid some of those mistakes.
Thanks for that. I think it is time for questions from the audience. Michael? A bit more time? Okay. Awesome. So I've got a few more questions. So we heard about venture philanthropy. We heard a little bit around impact investing, and then we also heard about social enterprise or non-for-profit. I'd love to hear from Rachel. What is impact investing? We've heard so much about impact investing, conscious capital, patient capital. What does all of that mean, and why is it important for us to understand the distinction between just general investing and impact investing?
So impact investing means a lot of different things to a lot of different people. Our definition of impact investing is that and particularly for Giant Leap, is that you don't need to trade off financial returns for social and environmental benefit. So a lot of people think that you have to trade off, and either you can do something good in the world or you can make money. And our view is, when you're investing in an impact startup, the two are intrinsically linked. So the actual benefit of the startup and the way that it makes money is through creating that impact. And GoTerra, the maggot farm that I talked about before, where they're managing waste, they make money by managing waste and using insects to do the job. So without managing waste and without diverting waste from landfill, they don't make money. So it's inherent that there's no trade-off there. Some people do feel like with impact investing, they might take sub-commercial returns, so they might take a lower return than what we're targeting. We're targeting the same returns as traditional venture capital funds. And then there are other options out there where there is kind of philanthropy and grants, etc. But in the impact investment space, it's kind of a longer spectrum of where you want to kind of generate the returns, and it depends on who you are and what your mandate is.
So I'd like to add to that is a very Australian context around the impact investing needing to have market returns. When you go to the UK and the US, that's not always the case. So it's really interesting that our market, and this is typical of the Australian market, is incredibly risk averse on some of this stuff. And that actually makes it harder for some of those businesses that are still proving up to get there. I totally get it, and working with Impact Investing Australia, it's the same discussion. The Australian investor requires that, but you will see very different shades of it across the world. It's cultural.
Yeah, and I'd just like to add something to that as well, because it is a really interesting conversation. We do impact investment as well at the foundation, and our strategy is very much social outcomes forward or first, and so that is the primary purpose. And then the investment comes second. And so just building on your point, there is a whole spectrum of different impact investment opportunities out there, and philanthropy is one of them.
And I think going to what Corinne was saying, it's definitely different. I think we were Australia's first 100% impact VC, and that was in 2016 that we launched. In the US, there had been impact venture capital funds for decades before. And so we do have a way to go in the Australian ecosystem. I think there are starting to be many more family offices and individual investors, etc., that are starting to be a bit more flexible with that definition. But we certainly had to meet people where they were at that point in time and continue to kind of be, and it's a bit of a journey of education.
100%. And this is all to say that not every startup will be right fit for impact investing as well. So that's something to keep into consideration. And not all businesses are fit for just your traditional VC, and maybe not all businesses are fit for raising investors' money as well. I'd just like to also touch on the current climate of investment. We've all heard about, the market condition, debacle in the crypto space and all of that. We won't get into that today. But we'd love to hear, as an investor, but also playing in this space, like from your perspective, what can founders expect trying to raise in this climate? Or what should they be doing? Maybe we'll go with Steve first. Stephen?
Yeah, I think from a philanthropic perspective, we're to some extent kind of protected from some of that volatility, and our grant making isn't dependent on that volatility. Our dispersal goes up and down with the market every year. So say 2021, I think we took a hit and we were only able to disperse 11 million in grants. But that went up slightly again in 22 to just under 12 million. So there is that fluctuation that you get, but ostensibly we can still grant a significant amount of money based on our corpus. So it's not as much of a concern in our grant making, because our grant making it's almost solely focused on the social outcomes. And so when startups come to us, we can provide grants that actually do provide some level of of protection if the social outcomes are aligned, and that's very, very important.
Yeah, and I think that also might mean that a lot of startups who weren't thinking about grant funding before might actually come to you then. So there's a bit of competition there.
Yeah, but you need your TCC and DGR. And that might not mean anything, but you can go and read about that somewhere else.
Fantastic. Rachel, your thoughts?
Yeah, I think it depends on, I guess, the individual investor as to whether they're deploying capital or not at this point and in this market. We were lucky enough to raise our second fund before the kind of market downturn. And so we have committed capital that we are actively deploying now. As I said, we're kind of in the middle of closing a few deals now. And so we haven't changed our method of operating because of the economic conditions. And I think that's the benefit of being in the private markets and away from the public markets, is that we're in an alternatives asset class, and we can, we do have the committed capital, so we can continue to deploy. There are some funds that are struggling to raise capital now, so they may not have as much, or the timing may not work to be able to deploy now. And so it really depends on, it's not all doom and gloom. There are some investors that are actively deploying, and angels, just individual investors, and funds that have capital to deploy. So I would just be doing my research if you are trying to raise capital in this environment. The thing to think about is that valuations have definitely come down, but equally valuations were potentially a bit frothy and a bit too high at a point in time just before the kind of market downturn. So there are these things to think about when you're thinking about raising capital, is what is the economic environment I'm raising in, and is it the right time for me as a business, because timing is everything for the success of a startup.
Fantastic. That's very reassuring that there are still investors putting in the money there. Your thoughts, Corinne?
Look, I think it has got harder. I think Rachel and her team are probably some of the few who are still putting out a lot of money. Really head to grants initially. It is a tough market. The lesson that I learnt, and I think is really, we had a great idea, the wrong timing. We got hit by the pandemic. So timing is critical. So sometimes it might be worth sitting on an idea, looking at what the policy, or when you're looking at grants, what are the themes that are of interest, trying to tie to that, and if it's not right, wait a bit. If we had launched 6 months earlier, we'd be in business. That just happens.
That just made me think of something else, actually, in terms of raising capital in a downturn. Government procurement and government grants, there was a heap of money being pumped into the economy from government at all levels, and that was an opportunity for not just for startup, for the whole business ecosystem. So that's always something to keep in mind as well, and that's also a benefit of if you were thinking about social enterprise or not for profit, you do have then access to government social procurement strategies. So the government does have, we'll get Michael to talk about that. Chew Michael's ear off about social procurement. He's big into that.
Yeah, and just to add on that, with Breakthrough Victoria, we are a $2 billion investment fund from the state government of Victoria, right? So we have $2 billion for the next 10 years. So, even though there's a lot of things happening in the climatic conditions in here, for us as a government-backed fund, we have money available in case you all are thinking about raising fund. The other question that I have, is it time for the audience? I just want to make sure that we have enough time for the audience as well. Okay. The question around I have is, founders, how do they prepare themselves when they meet an investor for the first time? I see a lot of early stage founders, they are like, oh, what do I put in my deck? What do I need to talk, and how do I prepare? So it'd be great from Rachel to hear about, like, what do you want to see in the deck or when you meet the founder first?
Well, there are a lot of resources out there to kind of find out what to put in a pitch deck. We have our cheat sheet on the Giant Leap website on what we look for. A lot of funds include that as well on their website or have resources that can help you with that. I know Sam Wong from Blackbird had put out a resource on how to put together a good pitch deck, which I think is really useful. There are, and Max Resources, again, there are lots of different resources you can draw on that are publicly available to look at what should be in a pitch deck. I would say no more than kind of 10 slides in a pitch deck. There's that Mark Twain quote, which is, "I didn't have time to write you a short letter, so I wrote you a long one." And so it's really about being succinct, because we look at 1,300 to 1,500 deals a year, and so we will spend at some times a minute on a pitch deck trying to absorb the information, and because we want to respect every founder that comes to us, and in order to get through that volume, we have to be really quick in what we're doing from a review perspective. And so getting your message across really succinctly and quickly is really effective. And also, if you can get introductions to investors and warm referrals, that really helps. But also really understanding the mandate of the individual investor or fund that you're approaching, because we get many cold requests that are totally misaligned with our mandate, and they're wasting their own time by coming to seek funding from us as well as ours.
Oh, that's fantastic. Stephen,
Can I ask Rachel a question? That's an astounding number every year. How do you feel it necessary or unnecessary to look at the relational aspect that early on, or do you wait until you then you've got to that stage where you're ready to invest, that the relational aspect comes in a lot more? And I'm just wondering about that, because I think from philanthropy's perspective, relationships are really important and trust is really important, and so we take our time a bit more, and it's quite hard with philanthropy and grant making organisations sometimes, because that relationship and that trust does need to be built. And just wanted to get your perspective on that.
Yeah, so we really do look at relationships and team being a huge part of our investments. So we invest in less than 1% of the 1,300 to 1,500 deals. And so we won't meet every single founder that we see, obviously, because we don't have the time. We have a limited amount of resource to be able to do that. And so we do look at data points, like if we can get introductions from other people, or we've got data points where they know someone, it's really great. But we also want to be non-discriminatory in that if you don't necessarily have the relationships and you come to us cold, we'll still look at the pitch deck and see whether or not it's a fit with the fund, and then potentially take a meeting. So putting your best foot forward when you have that opportunity to do so by providing a pitch deck really makes a big difference, because we've met many founders that have come to us cold, and it just helps with the warm referrals to have that extra relationship. But we do develop a relationship over time, so we're not investing as just off a pitch deck. We're doing our due diligence, where every single interaction thinking about whether this is a founder that is the right fit for our fund.
I think to add to that, I've got two pieces when we've looked at grants with Impact Investing Australia. One is, what problem are you solving? And how do you make money? Now, the number of applications I saw where that was not clear, it's, as you say, you've got that hundreds you're going through. And the second thing is you invest in that entrepreneur. So that 2-minute video or whatever you pitch, it is the person that's getting the money. That is first, the idea is second. So put your right foot forward, and I'll look at a 2-minute video and have a feel for, do they get the business, do they get the idea, and do they have the passion? They already get to gate one.
And you can tell if an application or a pitch has been massaged to fit. So don't do that. Don't do that.
That's rightly said. Another thing that I just wanted to quickly add is, especially when the founders are pitching, sometimes not just founders are pitching, but what I've seen is that a lot of the founders actually don't have connections and network. So I think opportunities like this, where you get to connect with StartSpace people or other accelerator programs, or even going to communities like Startup Vic, is very helpful, because that's where you might meet someone who's been through the Giant Leap Fund, and they might be able to share their experience of navigating the journey. Because especially as international students, I believe majority of you are here are international students. Navigating that journey can be quite difficult. So I encourage you all to really find a community that helps you. So in saying that, I would also like to go around the room and maybe ask for like one piece of advice that you might have for our future founders here. Stephen, you want to give it a crack?
I was going to say, just to add to your point,
Yeah.
there's mirror networks in the social enterprise and for-purpose space as well. So Nick at the back there, he's the CEO of Social Enterprise Network Victoria. So it's quite nascent here, but in Victoria we've got established networks, we've got established programs for social entrepreneurs. You can go to the Social Studio at Swinburne. There's heaps of resources and networks out there for social startups as well. My one piece of advice is really focus on the purpose. The purpose is paramount, and I think we've heard that message a couple of times, that you'll get found out if your purpose isn't clear to you and to your mission.
Rachel?
I would say just leverage the many resources out there and ask lots of questions to peers and join communities, and really be very curious about how to start your startup or to grow it and scale it, because there are lots of people that have done this before, and you could waste a lot of time if you don't do that research, because there's inevitably something out there that's going to help you. So really just ensuring that you're doing a lot of reading and understanding what you're getting into, and talking to lots of people and asking for help, and finding someone to bounce ideas off, and find a co-founder or someone that you can really talk to, because keeping that kind of internalized can often create a lot of problems where there are so many resources out there ready for you.
Corinne?
And I think what I said earlier, really around what is the problem you're solving. I think I've seen several times tech built and then looking at how do we purpose it for a solution. That's not the right way around. What are you solving for? Then build the business. It just becomes much easier to take it to the next stage.
All right, I think we have come to the end of the panel one. Are we still taking the questions from the audience? Off. Okay.
So we've got some questions from Slido, which was... Thank you, Stephen. You're a great friend. So we've got some questions from Slido, which was submitted anonymously, so I'm going to take credit for them. Is number one, you mentioned some of the criteria for startups and investment. What traction do you like to see for early stage startups before you invest in them? So you can say traction or criteria.
So I can kick off and hand my mic to Stephen so he can have a go as well. He's got one, great. So for us, the traction is real. We invest in seed and Series A stage, and there are varying definitions of that. But for us, seed is really $1 of revenue in the core product or service to show there is some kind of product market fit and willingness to pay. And Series A is more like $1 million in annualized revenue. And then we do have a small allocation for pre-seed as well, which is pre-revenue. But really the bar is very high for that. And what we like to see is momentum and things like users for the platform, and month-on-month growth in users and month-on-month growth in revenue. It is really about that momentum and trajectory to growth that we're looking for. So we don't, unfortunately, and to the frustration of many founders, have strict rules about the exact amount of revenue that we're looking for, or the exact number of users, or active users, or engagement, or anything like that. It's not an exact science for us. It's really looking for momentum to be able to look for the ability to get to a 10x business, possibility, not probability, of getting to a 10x business. And really, and what I mean by that is if you invest when the valuation is $1 million, you want to be able to exit at kind of $10 million. So really that kind of growth within a few years' time we're looking for. They talk about hockey stick growth, and that's what venture capitalists are really looking for. So momentum to indicate that you can get there in terms of scale.
So interesting. I'm loving listening to your answers because it's like, whoa, how does that kind of relate to what we do? And growth isn't necessarily something that we are looking for. It's impact. So you can be a small startup or a small social enterprise, but you can be having significant impact. And so that's the criteria that we look for. There has to be a measure of sustainability, financial sustainability, but it's really about, so some of the criteria that we would look at, for example, in my impact area, we focus on employment outcomes. So a lot of the criteria that I look at in an application are related to those employment outcomes. How many people facing barriers are you getting in and giving them a job? How long does that job last for? What sort of job is that? What pathways are beyond that job? So there's all those sort of criteria that we look at, and the potential for that impact before we disperse grant money.
But I think having tried to secure funding from both sources, although Stephen's sounds simpler, you actually have to be financially sustainable at the end. And I think the big question with grants, as Stephen said earlier, is what happens once we stop funding you? So being able to set up your models to be able to take that change in funding at the end. A lot of organisations struggle with that and therefore aren't able to access up front. But it's tricky.
Can you please give a warm thank you to the panellists on talking about money and funding? Very tricky conversation, as we've observed.